Hi, welcome to chapter 16, where we will learn how the effectiveness of both the monetary policy that the Federal Reserve in the United States um, control and how the fiscal policy, the executive branch, how both of them are only as much effective as the level by which they can impact the expectations. So if you want to have a really good monetary policy and fiscal policy, it's only good if it's able to impact expectations. So that's the key um, focus of this chapter. We've seen expectations and its role in the financial markets, stocks and bonds, expectations and its role in terms of impacting consumption and investments, and now how expectations are at the core of determining whether the monetary policy and the fiscal policy is as effective. So that is huge. So expectations is a big part. So if you remember one thing from this entire chapter, it would be that the effectiveness of the monetary and the fiscal policy depends highly on how they affect the expectations. Yeah, that is huge. So think about this. Imagine that this is the future self. If the future self expects after tax labor income to increase, what would happen to human wealth? Human wealth is all the wealth associated with direct labor. Like if you work at a company, at an employer for a paycheck, that's human wealth, labor. So after tax labor income in the future is expected to go up, then human wealth will go up. Yeah. Similarly, future real interest rates are expected to go down. Yeah. Then human wealth will go up. Yeah. Similarly, if we have future real dividends that someone expects from their financial wealth or non-human wealth, if the dividends go up, non-human wealth will go up. Yeah, because they'll get more dividends from their stocks, their bonds, their real estate property, and all of the non-human wealth that they have that's not tied to their direct labor. Dividends going up increases non-human wealth. Yeah, through um, investments in stocks and bonds as an example. Similarly, future real interest rates going down and future nominal interest rates going down increases non-human wealth as well. Yeah. So both of these increase will lead to increase in consumption today. Think about this. What's going to happen in the future if I know my after tax labor income is going to go up, my dividends are going to go up, my companies are doing well, I will start changing and consuming more today. Similarly, investments. If my future after tax profits are going to go up from the investments I made, the machines I bought, then the present value of those after tax profits goes up. And when that goes up, we saw how investments go up. We saw this in the last chapter, consumption and investments. Yeah. Similarly, future real interest rates goes down. Present value of after tax profits goes up. Yeah. Investments goes up. And if you combine both of them, then you could say aggregate private savings. If you add up the consumption and investment part and you call it A, aggregate private savings A, the function would say, hey, this is my consumption related. It's related to consumption, which is this part, plus investment related, which is this part. So aggregate private savings would be the sum of how much it goes up by the factor that consumption went up and investment went up. Yeah, consumption goes up, it has negative impact on taxes, and we saw that in the previous chapters. Yeah, so we're introducing this new term, aggregate private savings. It's basically combining these two that helps us really think through what will be the effect of monetary policy or the fiscal policy on overall output. So let's incorporate this aggregate private savings into what we've learned with the IS investment savings relationship from chapter 6 onwards. So we know Y output is C plus I plus G plus NX, yeah, and C is a function of how much taxes you have to pay and how much income you made, and so Y is a function of consumption plus investment income you made plus we also have this two aspects, real interest rate and X, which is the risk premium, yeah, and we have G, which is government spending. So we just went through aggregate private savings. If we combine these two, we could say this is aggregate private savings, CYT plus I YRX. And so what we see is that there is a clear relationship, yeah, as real interest rate, goes up, output goes down, or when it goes down, output goes up, yeah. Similarly, when X, in this case, is risk premium, if it goes up, then output goes down. If it goes down, output goes up, yeah. So now we can have a very clear association and add to this equation what people think about also the future expectations. If we extend what we have here in terms of aggregate private savings, it's also not just function of income, taxes, real interest rate, and risk premium, but also a factor of expected future output, expected future taxes, expected future real interest rate. Yeah. So now we just extended these to um, add in the expected part that people have. Expectations drive output in a big way, not just the current output, but also expected output. So that's the key addition of this formula. We are extending IS with adding in expected values of output, taxes, and real interest rate. Yeah. So that's the key extension of the IS curve. The key takeaway is either output or expected output increases, the aggregate private savings increases, yeah. Expected taxes or taxes today increases, aggregate private savings decreases, and same for an increase in real interest rate, either expected or current, will reduce aggregate private savings. So this is intuitive because we just went through this formula. What this leads to is a steeper IS curve. If you go back to the previous video, you will see the IS curve was slightly more flatter compared to this IS curve. It's much more steeper, yeah? What that means is that when you have a steeper IS curve, you would need a large reduction in current interest rate to have the same magnitude impact in output, yeah. Versus if you had a small change and if you had a flatter IS curve, you could have the same impact with smaller change. So what that tells you is that because folks expect future output in terms of their current decision making, future taxes in their current decision making, future real interest in current decision making, that this will have a huge impact in how they react today. Yeah. For example, if the change in taxes is positive, meaning tax actually went up, you will see that output will go from B to A. Yeah, it will go down when or it will not go down from beta. There will be a shift in curve from on the left. Similarly, expected taxes also increase. There will be a shift in curve to the left. Similarly, if expected output goes up, shift in curve to the right. Expected real interest rate goes up, shift in curve to the right, because people expect more income. And then if they expect real interest actually reducing, then again, IS curve will shift to the right or shift to the left. So that's the key takeaway. Um, there's a movement along the curve, which is point A to B or B to A, based on what is the current interest rate. Yeah. So that is what we will see how that movement along the curve happens, and that's primarily driven by the current real interest rate. but movement along on the curve versus movement shift in the curve, that's the key distinction to really understand. And remember, the steepness comes from the fact that now we've factored in expected future output taxes and real interest rate. Yeah. And this kind of makes sense because, you know, the multiplier effect, if you remember that, the multiplier will be smaller when you start to bake in future expected output taxes and real interest rate. Because even if someone has a big change in, let's say, current income, but if their expectations of the future income are not changed, then they'll not likely spend too much more. Yeah. Um, they'll change slightly, but not too much more, even when they had a huge current income increase. Yeah. So that's the part of multiplier. And to quickly remember that unchanged expectations have a huge impact, yeah, on output, and thus overall the curve shifting, which has a the curve shifts big time if expectations shift big time. Yeah. So now let's look at two situations: impact of monetary policy action and impact of fiscal policy. Let's start with the monetary policy. And there are two possibilities. We have expectations that are unchanged, or expectations of the future have changed by this monetary policy action. And let's also assume that if the expectations are unchanged, then you will see that, even if you shift the LM curve down, or if you have a reduction in real interest rate, the output will go slightly, but not really move that much. But in because we know the IS curve, we know the LM curve. So even if you have a monetary expansionary monetary policy, the shifting of LM curve down, you will see a slight change in output, but not as much. But if you had a monetary policy change with LM curve shifting down, um, and along with that, you have expectations of the future changed by the tone or by what people expect from how the Federal Reserve Chairman talked about the monetary policy action and the future guidance that they give in their FOMC statements or in their media presences. If they're able to change expectations by their actions and their words through the forward guidance, you will see not just the LM curve shift down, which is point A moves to point B, so output increase from YA to YB, but the curve also shifts to the right. And so B goes to C, so YA becomes YC. So there's a curve shift to the right, which has a huge impact on output when expectations change, versus when there is no change in expectations, you start to see a very slight change in, so let's say if this curve to go down, then output will be somewhere, if we draw the same line here, then output will go from here to here, but here it's gone up from here to here, which is a huge magnitude shift. Yeah. So expectations, folks, this is a key takeaway number one. Your monetary policy action of expansionary policy, in this case movement from LM to LM double dash, which is central bank lowers the interest rate, had a huge impact when the expectations were positively changed about a future output which is much higher. So that's the key takeaway. Yeah. And if not, the monetary policy will have much smaller impact. Yeah. Similarly, we have the fiscal policy, but before that, let's go over this topic called the rational expectations assumption. So in all of this topics, what we're assuming is that all people are rational in um, in the decisions that they make. By that, what do we mean? Yeah, by that we mean that they are using all of the available information when they are thinking about predicting the future. They're looking at all of the things that are available to them in the past, and the data that they're using is accurate and complete. So they're using all of the data that they need, and they're using all of that available information. They're using the forecasters who are providing various economic models. They're probably not building their own models, but they're using what's available, what's published, let's say, in news media that is validated, and some high level economists actually sharing the output. So they're using some of those from people who are doing this full time, and they're using their past experiences, not making systematic errors and mistakes in terms of estimating. So if we assume that folks are doing this and that they're learning from their past errors, then, and having done that, they're forecasting inflation, interest rate, etc., and making rational decisions about where the market is about to trend, then that is what's called the rational expectations assumption. Yeah. And so there are folks, economists now, who challenge this to be too strong of an assumption. But there are really good points about this. Assuming that people are making consistent mistakes, for example, or not really reading the newspaper, and then building policies or monetary action or fiscal action based on not expecting rational expectations, that would be really bad. So then this is the best alternative, and this field is evolving, and rational expectations is what currently is used when we went through, let's say, this part about monetary policy. We are assuming rational expectations. Similarly, when we are going to go through now fiscal policy, we are assuming rational expectation. So now let's imagine that there is a reduction in the deficit by the executive branch of the government, where they decide to go with a tighter fiscal policy. So when they do that, what do you think will happen? Will the output immediately go up or down? Well, it depends on three or four things. Many things actually. I've listed three or four from this chapter. The biggest one is, how credible is this government? The president, let's say when they announce certain fiscal policy, the executive branch, the president, and they announce, let's say, tariffs, or they want to uh, reduce the overall deficit by collecting, let's say, money from tariffs. That's their hypothetical assumption. Whatever that fiscal policy that they're trying to implement, or they're trying to cut costs, right? Wasteful cuts, like the Doge team that has been set up, trying to reduce wasteful cuts and things that are not efficient. Then depends on how credible people think is their action, and also how they expect and anticipate future cuts to happen. And it also depends on the fiscal policy, also depends, the action also depends on the level of current debt that the country has and how quickly the debt is rising, and also whether the monetary policy is in conjunction working together with the fiscal policy to make it land well. So there are various factors on whether deficit reduction actually, the task taken by the fiscal policy actually improves the output or not. So if it output could go up or could go down based on government spending reduction, um, based on all of these factors. Yeah. And what we saw in 2000, I think 2010 and 11 in the euro area, is that the larger the fiscal consolidation plan that the government had in those countries, let's say Greece, the larger was the forecasting error. By that, what it means is that expectations. Um, what is forecasting error? Forecasting error comes from the fact that they assume multiplier effect of how much this consolidation will lead to multiplier effect, and then they assume a small multiplier positive. But a negative forecast error, meaning the models that assumed a positive multiplier were actually wrong, because they had a huge amount of consolidation planned, and the models were so wrong because they assumed implicitly a fiscal positive multiplier. So what that tells us is that net net in this experiment, from this data that we see in 2010 to 2011, the net impact was contractionary, right? Meaning the output actually went down because of fiscal consolidation. Yeah, because the adverse effects um, of that contraction, the expectations were not able to be offset as much to have a positive impact. So it depends on various factors. It's just one data point for a 2-year period in the euro area. But the impact on fiscal policy depends on what are the expectations people have. If they expected a much higher deficit reduction and the government did a much smaller deficit reduction, that's a problem. If they were surprised by the tariffs that they thought will never be acted, but now they are acted on, so then the amount of surprise that is baked in impacts the expectation, and expectation we saw has a huge role to play in output. So every every big external event, a new president gets elected, tariffs get introduced, Federal Reserve reduces the interest rate, Federal Reserve has a new chairman appointed, a new Federal Reserve chairman was elected, and so on and so forth. You should see the impact on the stock and the bond markets, which we saw previously, and that will tell you how much was the level of surprise in that news. And if there was no change in the stock and the bond markets, then all of a sudden you can say that those expectations were not um, uh, impacted with any negative or positive surprise. If it's a positive surprise, stock market, bond markets will go up. Negative surprise, they'll tank. So that's a very clear evidence about aggregate expectations that's built in, and that has a huge role in the fiscal policy and the monetary policy. That's the key takeaway in this. Uh, we've talked about expectations about the future. This topic will not be complete unless we talk about uncertainty. Remember, when we have expectations about the future is uncertain. And so this volatility index, VIX, is one other way in which you can measure uncertainty. Yeah, higher the uncertainty, higher the amount of folks who would be on the sideline, right? They will wait for uncertainty to be clear. If the president is expected to introduce tariffs, but introduce at a smaller magnitude. And the news media, this news that says it's going to be much higher, so the volatility and uncertainty would be increased. Because remember, as executives, as leaders who are trying to make investment decisions, they wouldn't want to make investment decisions that are big because it's hard to roll back. And if there's lots of uncertainty, they'll wait for that uncertainty to drop. So higher the uncertainty, also impacts overall expectations and thus overall um, output. So this is another important aspect. And tariffs that are uncertain or unexpected, or the magnitude, have a huge impact on uncertainty. And you can see this. This is an image from Google Finance. It's linked. Um, if you click through this link in the slide, you will see WIX, which is volatility index. All right, so that concludes chapter 16, which is effectiveness of monetary and fiscal policy depends hugely on how they are able to affect the expectations of folks involved in aggregate. And we saw how we can use the stock market and the bond market to see the level of surprise, positive, negative, no surprise, to look at the data and make sense out of it. To recap, 14, 15, 16, all these three chapters talk about expectations. Expectations about the current and the future activity determine the bond and the stock markets. Is what we learned um, in chapter 14. Chapter 15, we looked at how expectations about the future drive consumption and investment decisions. And finally, we saw how expectations about the future drive the effectiveness of monetary and fiscal policy. This is super interesting. With this, you should be able to read the news even more uh, carefully and with a lot more data that you can use to connect the dots as to how much was a positive or negative surprise, and be able to look at the world much more rationally and much more completely, and slightly more completely than what you used to before. Yeah. So in the next chapter, 17 onwards, the next four chapters is going to be about the open economy. So 17, 18, 19, 20. We'll go through that, and then we'll continue our journey together. Yeah. Thanks.